It's imperative that we have leaders such as yourself who appreciate the foundational role that natural gas can play in improving the environment and supporting a strong economy. I think the innovative example of the Clean Air, Clean Jobs Act has drawn national attention to the significant benefits of taking a holistic and long-term view towards meeting our energy needs and reducing harmful emissions. And your inspiration made that happen, and for that we all thank you. And I've gotten over being locked in a room with the threat of vegetarian pizza for a week until we had something that we could agree upon. So. Building on your remarks, this afternoon's panel will take a look at the opportunities for the future use of natural gas. And to lay a little foundation for that discussion, I'll share a little information, some of which we touched on this morning. This slide here shows the 2011 Potential Gas Committee resource study with 1,900 TCF of potential resource available for future use. That's twice the figure from 1990, as you see the chart on the left going up to the right. And during that period, we've consumed 400 TCF. So this abundance is being driven by technological revolution in drilling and completions. Now the next chart here is a really exciting supply curve that shows supplies at various prices by various sources of resource. And just to take away from this chart, so you have a development cost on the y-axis and you have quantity on the x-axis. And what you should take away from this is the resource is relatively low cost. 1,500 TCF are recoverable in North America at $5. That's 55 years of current consumption. The market has taken notice of this. This chart shows the historical on the left, and on the right side of the red line, the current futures market for the price of natural gas, ranging from $4 to $8 over the next 10 years. This slide shows the U.S. Energy Information Administration's price projections over the last 3 annual outlooks that they do. And you can see a couple of things. Their current outlook shows a price outlook between $4.50 and $7.50 for Henry Hub out through 2035 in the study. And these projections for prices have been coming down. So what does that all mean? Well, I think the strategic question becomes one of understanding the transformative nature of an era of abundant and economical domestic gas resources. So, what are opportunities for the beneficial use of this resource, particularly in power generation and transportation? What are the potential impacts on the market? What changes could result from public policies directed towards influencing natural gas and oil demand? All very important questions. And to discuss these dynamics, we have an excellent panel of experts here today to share their perspectives and expertise with us. So with that, I'm going to start out. We have 4 panelists, and after that, we'll have some Q&A for the entire panel. Start out, your speaker bios are in your conference brochures, but first we have Susan Aragoni. Susan is the Vice President of Fuels for Xcel Energy, which means she buys a whole lot of different fuels, and there is no one around that understands the relative merits of one fuel as compared to another than Susan. So I've asked her to come join us today to share her thoughts about the role of natural gas and its interplay in the fuel selection for utilities. So with that, Susan.
It is an honor to be on this panel, and I too want to extend my thanks to former Governor Ritter for his leadership and vision when he started on this path. I don't think anyone really had a clear vision as to where we'd end up. Today, I've been asked to share with you what the perspective is of the utility business with respect to fuel for electric generation. And I'm going to kind of start with where we are today, and this is after Clean Air, Clean Jobs here in Colorado. So I'm not going to give you a rundown of how we got here. I think we've seen that before. First, there we go. Let me show you a little bit about Xcel Energy. We are a very large company, the 5th largest combined utility in the country. We have 1.9 million gas customers, and that's with our gas LDCs in Wisconsin, Minnesota, and Colorado. And we also have 3.4 million electric customers. We buy 400 BCF of gas every year combined for both electric and our LDC customers. Kind of going down the spine there of the country, our operating companies are Northern States Power, Public Service Company of Colorado, and Southwestern Public Service. And this is the result, Xcel Energy is a result of two major mergers over the course of the last 15 years or so. And you'll also notice, and I think this will become more interesting as we proceed, that where we are is down the spine of the country, and where we are is where the wind blows. So that is one of the issues that we deal with in terms of fuel for the future. Many of you may think that we don't utilize much natural gas today, but I wanted to give you this perspective, and that is our generating capacity, and this is our owned generating capacity. And you'll notice that from a capacity perspective, we're almost equivalent to coal. That might surprise many of you. Now, however, I will admit that much of that natural gas capacity is for peaking units that don't operate at a very high load factor. And you'll also notice, and you might find this surprising, that from an owned perspective, we only have about a little over 300 megawatts of wind generation. And I would add to that we do buy gas for tolling plants, so we add about 3,000 megawatts of gas to that. But back to wind. In spite of the fact that we don't own much wind, we have contracts and long-term contracts for a lot of wind. Right now, we're at about 3,432 exactly megawatts of wind. That was as of 2010. We expect that to grow to about 5,000 megawatts by 2015. And our wind source program, and that is based on the wind that we own here in Colorado, is one of the largest subscribed programs that we ever saw existing. And, you know, kind of back to wind, I was reading this past, I don't know, it was yesterday or the day before, EIA's latest weekly publication, and I found some astounding facts that I thought were really, really profound for the energy business as a whole, relating to all fuels. And the first headline I saw that really surprised me is that the consumption of primary energy derived from renewables recently exceeded current and historical, and it went back about 15 years, consumption levels for nuclear energy. First time ever. That was this last quarter. Another astounding fact that probably doesn't please the coal business very much is that the share of electricity generated by coal during the first 3 months of the year was the lowest first quarter level in more than 30 years. I have a few more facts about that, but I won't go on. And this is really significant, and we all know it's been hot. It's been hot everywhere. But in the last week, 4 regional transmission organizations, that includes MISO, the Midwest operator, PJM in the east, the New England ISO, as well as the New York ISO, all set or just missed daily demand records. That includes us. We set new peaks in all 3 of our operating companies over the last 2 weeks. So it's been hot, and we've made a lot of electricity, and a lot of that has been fired by gas generation. The final headline that I thought was profound relates to the gas business, finally, and that is El Paso Corporation, the largest natural gas pipeline project dedicated to serving the western United States. That's their Ruby pipeline. Since the expansion of the Kern River system in 2003, so that's for 7 years, received approval from FERC to begin operating last week. I believe it was July 28th. So lots of pipeline infrastructure has been added, including Ruby. This one's going west, and the hope is that a lot of this unconventional gas that we've been talking about this morning will be flowing west to California. So what is this? We've all heard a lot of talk about the natural gas business is changing the game. It's changing the game in a lot of ways for electric generation. So we're all focused on the unconventional plays. We saw a lot this morning about that. Really good information, a lot of really hopeful technology advances that we will rely on from the utility perspective on you to continue to advance. This drilling technology supposedly has been portrayed as having a potential for a 100-year supply for domestic production. So what does that mean? We hope long-term, lower, more stable prices. That's really important. If there's anything that an electric utility finds problematic, it's uncertainty with respect to cost and prices. So there's also a perception that a gas supply shortage is improbable in the future. That is something that we'd like to be able to rely on. The key to understanding this, from my perspective, is for you to understand your customer. And with that, I'm going to switch to some of the drivers that we face in the electric generation business. These include incredible uncertainty with respect to environmental regulation. We need rules, we need to know what they are so that we can make long-term decisions. These rules drive capital expenditure requirements for us, and they are major, hundreds of millions of dollars to be invested on behalf of our customers. And those investments are long-term investments. A gas combined cycle investment is a 40-year project. We are also faced with increasing fuel costs, and that is a result of switching more of our coal generation to natural gas, as well as issues that relate to the resources available to us from renewables. State public utility commissions, how are they going to respond to these increasing costs? At some point, we're worried that they might throw up their hands and say, no more, we're not going to allow you to increase rates. And you all know that we are regulated in all of the states that we operate in. The pace of the economic recovery is very important to us. Everybody's seen a drop-off in our demand and our energy requirements over the last 2 years. We're coming back, but we're coming back slowly. So what is it that we're going to need for resources in the next 10, 20 years? And then maybe it's not this way everywhere, but in the states that we operate in, resource planning is contentious. We have many, many different interests involved in helping us make decisions about what resources to put in place. And particularly, the environmental issues. This is something that I'm going to ask someone in the back row to read. No, not really. But this is what we call our heart attack graph. It's the EPA regulatory schedule, and it's color-coded to deal with all of the different emissions issues that we face, in particular those impacting coal generation. So as your customers, as we are your customers, it's important that you understand that we're making compliance decisions based on this timeline, and it is uncertain. These little arrows move around all the time. We update this frequently. This is from a presentation I did a couple of months ago, and I just thought I'm just not going to bother with updating it. But there has been a major change. A good example of this uncertainty is what we call the CSAPR rule, the Cross-State Air Pollution Rule that was issued just a few weeks ago. That was replacing the CARE rule, that's the Clean Air Interstate rule, that deals with, requires regulators to reduce emissions from NOx and SO2. This will impact coal usage. It's a foregone conclusion. You've almost got an open issue there for you to deal with, and that as coal generation is reduced, the obvious replacement is natural gas. What was a surprise about this rule is that the draft rule that was on this schedule didn't include the state of Texas. We operate in the state of Texas. We have a lot of coal generation in the state of Texas, and right now we're grappling with how we're going to comply with this rule, which requires compliance on January 1st of 2012. So in just this latest issue of PIRA's latest issue with respect to their I think it was their natural gas monthly forecast, and a peek into 2012, PIRA called this rule the gas market's standout 2012 demand side issue. So get ready, you have opportunity. Now what I'm going to show you here, and this is just our view of things and what's changing and what the opportunities might be, and this is the result of our resource planning efforts. So what you have are actual generation resources and how they were dispatched in 2010 from a fuel usage perspective. So you can see there, and that is all of our operating companies. So you can see that we're about 50% coal, and then the rest is split between natural gas, renewables, and nuclear. In 2020, the view is, and this is based on planning, will be more heavily weighted in natural gas, just slightly, but much more heavily weighted in renewables than we are now. Coal will go down by about 10% in comparison. And so you can see that overall, when you blend it all together, we'll be going forward with more renewable resources. This also does incorporate growth, so it's not as if there's the same amount of energy being consumed. Now, when you go to the OPCO level, and this is the First Public Service of Colorado, you can see that there's real differences among our operating companies as far as how this plays out. In Colorado, what you're seeing here is the results of what Governor Ritter talked about, the Clean Air, Clean Jobs plan that we filed and was approved by the Public Utilities Commission. We were at 61% coal in Colorado in 2010. We'll be going down to 43%, and then in 2020, and natural gas will grow as well as renewables. Quite a different situation at Northern States Power, and this is our largest generation source. We have nuclear there, and any new growth that comes on the system is first going to be taken up by nuclear because it is our lowest cost plant. Those are our lowest cost plants in the stack. We are growing our nuclear business by uprating all 3 of the units that we have up there. So we'll be adding in total about 100 megawatts of nuclear over a longer term period. But you'll see that coal generation is being reduced over that 10-year period. We are converting one of our coal plants up in Northern States Power, switching that to natural gas, but building a combined cycle there. So we're really, at the bottom line, we're going to only have 2 coal-fired plants in Minnesota. Renewables are also growing. So you can see how the share of the pie is growing for gas and for renewables, and it's growing at different rates depending on the company. The first thing I can say about SPS is that this is not correct because of the CASPR rules. We don't know how this is going to play out by 2020. But right now we're about 52% coal, 40% natural gas. We are losing fairly significant wholesale load down there. We expect that to go to a different system. So that's why it changes a little bit, but we'll still be pretty heavily reliant on coal while at the same time utilizing a lot of natural gas. So from a resource planning perspective, I thought I'd jump into that just to show you a little bit about what we think about. First on the list is the cost of natural gas. How we arrive at these plans is based on all of these costs on a combined basis. It's a very important function at Xcel. When it comes to the key drivers listed here, it's very important to think about not only the natural gas, but what is going to happen in the future as far as carbon costs are concerned. We've been grappling with that for several years. The uncertainty with that is a major concern for us. And we also have to consider capital costs. When you think about wind, solar, the gas combustion turbines or combined cycle, all those are factored in. And then finally, what does the resource need? Do we need peak day capacity or do we need energy? So the resource decision is made rolling in all of those costs, the fuel, the capital, the operating expense, and it's all looked at over a very long term. Kurt Hager, one of my colleagues, one of the smartest people at Xcel, I think, spoke to you in 2009, and his talk emphasized something that's very important, and I'm going to kind of continue with that thread here. And his talk focused on the fact that gas is really in our area, and this is particular to Xcel, must compete with renewables. I think you've been focused on coal, but it's time to think more about renewables in order to gain the market share that you would like to have with generation. He really couldn't have given you better advice 2 years ago, and I would like to reiterate a couple of points now. He spoke then, and it's still true, that natural gas is a complement to renewables, and we use it as a swing fuel when the wind doesn't blow. We rely on gas generation to fill that gap. As most of you know, especially over the last few weeks, the wind tends to die down when the electric load is at its highest peak. So that can be a problem for running an electric system, and believe me, when you have the amount of wind on the system that we have, it is something that we are continuously sharpening our pencil and refining our abilities there. It also will help us get into compliance with carbon regulation. So that's the complement. Where are we? Where is it as a competitor? It is a competitor to renewables with respect to natural gas. Natural gas competes with renewables. And this is just a back-of-the-envelope thing that you probably already know, but $1 increase in natural gas is equivalent to a $7 increase in dollars per megawatt hour in terms of how the system is dispatched. So while at the same time, wind turbines are becoming much more efficient. Back in 2009, when Kurt was making this speech, efficiency was at about a 30%, meaning that the capacity factor was at about 30%. New wind turbines now can operate at about a 50% capacity factor. So that's something to consider. So we talked a lot this morning about some of the risks, and this is from our perspective. We have long memories in the utility business, and one of the words that was used this morning is a word that we don't like to hear with respect to gas prices, and I think it was used by Dr. Duncan. The word is gyration. That's not a good word for us. So we're worried, frankly, about the controversy with respect to fracking and the potential regulatory response and the potential impact on prices. We see the high decline rates in the first year. Sounds like from this morning things are being done to help with that. The lease options, which, drill or lose. So we see supply coming on the market. Is that going to fall off as these the lease options are fulfilled and supply backs down? And will there be sharply higher demand and sharply higher prices as a result of an increase in electric generation and fueling with natural gas? I will mention this with respect to clean air, clean jobs, because this is where I lived. Part of the law was that, and these are words from the law, that the General Assembly found that basically natural gas is a good thing for electric generation customers, and that long-term contracts would be a good idea for natural gas in a manner that protects utility customers. And in that regard, the thought was more of a fixed price look, a long-term contract, something that could take out that potential for gyration. What did that mean, and why did we need it? Well, I've had a lot of fuel buyers that have called me up and said, geez, how did you do that? And my first response is, you need a law, because regulated utilities are subject to prudency reviews with respect to their fuel purchases. And what we got out of this law was the opportunity for the Commission to review a contract or contracts. Once they approved that contract, which they did, there's no opportunity for a future commission to look back and say, gee, we don't like that. We'll disallow a few $100 million of cost, which is an incredible risk that no utility is willing to take. So that's how we move forward with that, and that's the benefit that it has for us. So what do we need? And this is my final message to you, is tops on this list is we need reliability. As we dedicate more and more of our load to electric generation or to gas generation, we need the gas to show up, and we need it to show up all the time. especially on peak days. We need new thinking about long-term pricing, and by that I mean predictability, and we need stability. We ask you to come to us with proposals that are a little different than maybe what you've looked at before. You need to understand our regulatory environment and understand that we are not paid to take risk with respect to fuel. So we are very, very sensitive to those issues. And finally, we need financially healthy business partners. So in this current pricing environment, we understand that $4 gas is not something that can be sustained over the long term. We're very, very willing to recognize those issues with you. So I hope that you are taking away from this some thoughts that might help you succeed with selling gas in the electric market in the future. Thank you.